Innovation in the International Financial Markets. Gunter Dufey, The University of Michigan. Ian H. Giddy, Columbia University. Journal of International Business Studies, Fall 1981. Abstract. New financial techniques and instruments are created when both the demand for and the supply of those instruments becomes sufficiently large. New financial instruments appear almost always to represent new combinations or packages of a relatively small number of financial services. In the international context, these packages are designed to cope with controls on international financial transactions and with the peculiar interest and exchange risks faced by international firms and banks. This approach, when applied to a wide range of new international instruments, seems to explain why some have failed and others have succeeded. Innovations in international financial markets arise when firms, usually financial institutions, find it profitable to offer or employ a technique or instrument which better fulfills one of the four functions provided by the international financial sector. 1. Liquid and standardized instruments for effecting payments in individual currencies. 2. Mechanisms for conducting monetary exchange between different currencies. 3. Institutions and markets for channeling savings into investments across national boundaries. And 4. Mechanisms for allocating, diversifying, and compensating for risk. The objective of this paper is to develop a theory of innovation in financial markets and to focus on factors which determine the creation and likelihood of success of such innovative instruments. Innovation of any kind involves, among other things, the production of new information. The conditions for the socially optimal level of information generation and the optimal subsequent pricing of that information have been considered by Arrow, 1. Demsetz, 19. And Johnson, 32. As well as others. While often costly to produce, new information can be used by any number of people without additional cost. It is a public good. The socially optimal price of a public good is zero. Indeed, the more easily new information is disseminated, the more likely its price will quickly fall to zero, thus reducing or eliminating private incentive to produce easily duplicated innovations. This is Arrow's appropriability problem. 1. 3 ways to reconcile this dilemma have been proposed. The government can create the information itself. The government can award prizes won to innovating firms in exchange for the right to disseminate the information freely. Or private firms may be able to appropriate the returns through the creation of patent-protected temporary monopolies. Where government intervention is absent or patent laws provide poor protection, as is often the case in international business, there is either little incentive for innovation or the market for innovation is internalized and the value of innovations exploited within the firm too. Hence the existence of large, multinational firms in information-generating industries. In either case there will be welfare losses. In the former case, from inadequate innovation, and in the latter, from the reluctance of monopolistic firms to share the new information they have generated. Two strands of thought can be discerned in the meager literature on innovation of financial instruments and techniques. 3. One view holds that the spur to innovation comes mainly from an increased demand. The other view emphasizes changes in supply. To our knowledge, the first consistent framework was supplied by Greenbaum and Haywood, 27, who stress rises in non-human wealth per capita as the primary, demand, stimulus to innovation. Extending the Gurley-Shaw, 28, hypothesis, Greenbaum and Haywood argue that because of fixed costs involved in portfolio management, increases in individuals' and firms' non-human wealth will result in a greater demand for a wider diversification of financial claims. Supply, in the Greenbaum-Haywood model, is largely a function of improvement in information over time. In contrast, Ben-Horam and Silber, 6, stress supply factors, particularly those associated with external constraints, regulatory or otherwise, imposed on financial intermediaries, and the availability of institutional support. They find some evidence that major U.S. financial innovations, such as negotiable certificates of deposit, occur in response to significant increases in the costs of financial constraints on banks. These increases alter the relative costs of various factors in financial service production and so lead to a search for new financial techniques or instruments with a less costly factor mix. Both studies, then, hold the view that innovations result from changes in the financial environment and from responses aimed at maintaining or increasing profit or income. Although innovations can be defensive, as well as aggressive, environmental changes seem to provide the necessary incentive for innovation. Whether the level and price of financial innovations are socially optimal remains unresolved. On the other hand, the environment may also act as a disincentive to innovate. In any industry, the incentive for innovation will decline when patent protection is less effective, when the industry is potentially more competitive, and when product imitation is easier. Financial innovations are extremely easy to imitate because the instruments possess a limited number of attributes, each of which is characterized by degree of risk and expected return. These in turn are functions of maturity, liquidity, the guarantor, and so forth. 5. Thus, we view most financial innovations, except those designed to circumvent regulations, as no more than a change in the combination of features of existing instruments. If this is correct, all an imitating firm need do is observe the particular arrangement of attributes in a competitor's contract and replicate them. Because of the technical ease of imitation and the difficulty of proving any financial contract to be unique rather than a variant of some existing combination, there can be no patent system for financial instruments or techniques. In light of these environmental disincentives, one might suppose that the innovation rate in financial markets would be relatively low. Yet observations of the U.S. and international markets indicate that new instruments and techniques, successful and unsuccessful, have appeared frequently over the past 2 decades. To understand why this is the case, and which firms find it possible to retain profits from their financial innovations, a brief excursion into the literature from the advertising field is necessary. A distinction has been drawn by Nelson, 42, between search goods and experience goods. The qualities of the former are evident on inspection. Advertising need only be factual. The qualities of experience goods, on the other hand, can be determined only by consuming them. Physical product innovations are search goods. Any firm that can produce them can also sell them. This ease of entry is what makes patent protection necessary in such industries. Services, however, including complex financial services, are experience goods, at least when first introduced. Because the risks and returns are hard to ascertain, customers will tend to purchase new financial instruments and services only from firms that have a sound reputation. Hence, there is an economic rationale for certain highly reputable financial institutions to specialize in the repeated development, marketing, and support of new financial contracts. These institutions will enjoy a temporary monopoly advantage that enables them to appropriate returns from investment in financial innovation. Even where the imitation lag is zero, innovation will continue, because new entrants with less prestigious names will normally be unable to appropriate the returns from innovation directly. The market for their talents will be internalized. Inventive individuals or firms will tend to be absorbed by those who command the most confidence. The higher the costs of introducing financial techniques or instruments, the more strongly this conclusion holds. Silber, 52, has observed that, because financial instruments are held for their returns rather than for their direct utility, the ease with which a secondary market can be established strongly affects the likelihood of early success for new financial instruments. In some cases, the innovating firm may have to create the secondary market. The development and maintenance of such support constitutes a fixed cost, creating economies of scale and an obvious free rider problem. 6. Only a large firm with an efficient distribution network will be able to reduce such fixed costs, and only one with a reputation-induced temporary monopoly will be able to recover such costs as remain. Given an institutional mechanism for the continual generation of financial innovations, the theoretical problem remaining is to be able to predict what kind of innovations will appear, under what circumstances. As was observed in the previous section, innovations can be of 2 kinds: aggressive innovations, which are developed by firms specializing in new financial product introduction, and defensive innovations, which arise in response to changes in customer needs or in relative costs. 7. The former are presumably random and, in the financial industry, relatively infrequent. The latter, however, should be predictable. The hypothesis of this paper is that all defensive innovations are of 2 types. A. Changes aimed at circumventing government regulations of the price or quantity of financial services. Either the regulations themselves change, or their effective costs change, or b. Adaptive changes resulting from changes in relative prices or relative risks that give rise to a gap in the range of available financial instruments. The first type has been discussed frequently in the past. See for example, 27. Silber, 52. Generalizes the notion to other constraints, including self- and market-imposed constraints. Many such innovations involve altering the jurisdiction or legal form of contracts without changing their riskiness or return. The second type of defensive innovations, those that arise from newly emerged gaps in the range of financial services offered, 8. Usually involves either unbundling or combining existing financial services. Unbundling of various services allows each to be priced and sold on its own merits, whereas combining services often reduces total transactions costs. Thus one might expect combining instruments to emerge in retail markets, and isolating instruments to appear in wholesale financial markets. Instruments that serve purely to transfer risk will likely emerge when risk in the financial environment increases. Some special conditions in the international financial environment have a bearing on financial innovation. A. The regulatory environment is multinational. B. The competitive conditions differ, and, circa. Exchange rate changes constitute an additional risk. Each feature will be considered in turn. Institutions that have the flexibility to conduct business outside particular national jurisdictions can also design financial contracts that place the legal location of the contracts in favorable jurisdictions. Many international financial innovations, such as Eurobonds, are structured to minimize government interference and to reduce taxes or other regulatory costs. In general, however, it is an oversimplification to claim that international financial transactions are exempt from government regulation and control. Indeed, the general rule is that controls on transborder transactions such as transfer of financial instruments from one jurisdiction to another are more severe than those on internal transfers. Whether the regulatory environment is more or less restrictive cannot be determined a priori. In some instances, the greater relative freedom has permitted the creation of new instruments, not available domestically. In other cases, greater restriction on international transfers of funds has produced innovations designed solely to circumvent the controls. In the absence of patent protection, some degree of monopolistic control is necessary for a firm to capture the returns from financial innovation. Because a greater number of large, experienced financial institutions participate aggressively in the international markets than in domestic markets, the degree of competition and the probability of rapid initiation is heightened. The incentive for innovation should accordingly be reduced. Yet, the opposite extreme, the protected, domestic, cartel-like banking system is not conducive to innovation, either. Arrow 1. Has shown that the gains from cost-reducing innovations are smaller to a monopolist than to the competitive firms which can appropriate those gains. This confirms what intuition would suggest. Monopolists or oligopolists face less pressure to innovate than do competitive firms. It is not clear, however, whether an innovation is likely to spread faster in a competitive market than in an oligopoly. Whereas competitive firms facing a high elasticity of demand will be forced to copy a cost-reducing innovation quickly, it is also true that oligopolists and cartel members tend to undertake major changes in concert. These considerations aside, it seems clear that, on balance, the rate of production and spread of financial innovations is greater in international than in domestic markets. One reason is simply the wider range of needs for specialized financial techniques. Another is that the greater variety of institutions and ideas in the international market leads to cross-fertilization of concepts and techniques which can be incorporated in new instruments. More participants also ensure better secondary markets. Most important, however, is the fact that the potential market for cost or risk-saving techniques is much larger, even if the imitation lag is shorter. Finally, the international environment involves fluctuating exchange rates, which not only create new risks and new types of transactions, but also require that financial institutions intermediate between entities which have different base currencies and different degrees of access to foreign exchange markets. As exchange rates and other financial variables have become less stable, the risks of international business have increased and the scope for financial innovation has expanded. Changes in regulation and changes in the economic environment that produce a different set of risks and returns have been the inducements to defensive innovation in the international context. During the 1960s, rapid economic growth and increasing capital mobility in the industrial countries led governments to establish capital controls to defend their monetary policies and the fixed exchange rate system. The banks quickly responded by implementing techniques designed to circumvent these and other regulatory constraints. This was the decade in which Eurobonds, Eurodollars, and parallel loans were introduced. By the mid-1970s, in contrast, the regulatory incentives for financial innovation were overshadowed by new economic incentives and changes in the competitive structure of financial markets. Floating exchange rates freed governments from the need to defend misvalued currencies. The financial systems of many major countries became more flexible. Interest rate and credit controls had begun to lose their effectiveness. Governments themselves took advantage of the innovations of the previous decade by placing, borrowing, and recycling funds through the euro markets. With greater mobility and flexibility, however, came greater financial interdependence and a period of adjustment to a changed system. Governments, attempting to compensate for the dissipated effects of traditional stabilization policies, increased their intervention in the money and foreign exchange markets. Yet all that resulted was a less stable system, evidenced by the increased instability and volatility of exchange rates, interest rates, and inflation rates during the early 70s. The decade of the 1970s produced innovations to cope with exchange and interest rate risks and led to a boom in trading Eurodollars, Eurobonds, and floating rate notes. The remainder of the paper examines these and other innovations, and the reason for their success or failure. This section describes the international financial innovations that must be considered successful, if only by virtue of the magnitude that they have attained. The sequence moves from variations of traditional trade financing techniques to more exotic combinations. Then some examples of techniques and instruments that were not successful will be discussed, and an attempt will be made to draw some conclusions as to the distinguishing factors. The first example illustrates how an age-old technique, export financing through bankers' acceptances, can be successfully adapted to take advantage of new opportunities provided by changes in the external environment. The factors that gave rise to forfeiting, 9, are closely linked to the activist role played by many governments in the economic development of their countries, particularly, but by no means exclusively, by the socialist countries. There, government-owned enterprises frequently import capital goods, often in the form of turnkey plants, from suppliers in industrialized countries on extended payment terms related to the life of the project. Such maturities, which may range anywhere from 3 to 12 years, cannot be handled through the institutions that traditionally undertake export financing. From the point of view of the exporters who may finance such transactions by borrowing in the markets, this would be costly. More important, technologically oriented capital goods manufacturers feel very uncomfortable with the economic and political risks associated with loans to foreign political entities. Forfeiting solves the exporter's problems, and it is also advantageous to the borrower, that is, the importer. A typical transaction involves 4 parties: the exporter and the importer, the importer's bank, which also tends to be a government entity, and the forfeiter, usually a special-purpose subsidiary of one of the large Swiss, West German, or Austrian banks which have pioneered this technique. When the exporter's negotiations with the importing organization are nearly complete, the exporter obtains a commitment for the forfeiter to finance the transaction at a firm interest cost. This cost is the discount at which the forfeiter will purchase at the time the deal is completed. The forfeiter also charges a fee as compensation for the cost of assuring availability of funds, which may require him to borrow funds on a long-term basis and reinvest them on a short-term basis during the commitment period. 43. When the transaction is completed, the importing organization gives the exporter a series of promissory notes with maturities staggered according to the repayment terms, usually in 6-month intervals reflecting the installments. Most important, these promissory notes are endorsed by the importer's bank, which becomes the primary obliger in the transactions, just as in the case of a banker's acceptance. The forfeiter will purchase the total bundle from the exporter without recourse, thus assuming the risk of the state-owned bank and, ultimately, of the government of the importer's country. The essence of forfeiting involves shifting the country's risk to an institution that specializes in assessing such risks. But the forfeiter is also an international market specialist. Usually the package of notes is broken up and sold to various investors who prefer different maturities. The forfeiter endorses the notes, thus collecting the risk premium in addition to the difference in yield between the value of the individual note and the discount which he obtained when he bought the package. Thus, the forfeiter exploits both differences in perceived political risk and also, possibly, imperfections in international money markets arising from transactions costs. While it is fairly obvious why government banks will endorse the notes 10. They obtain funds which contribute to the economic development of their country. It is not so obvious why they do not borrow directly in international credit markets. Here we encounter another market imperfection. The government banks believe rightly or wrongly that the obligations stemming from their endorsements, which are contingent liabilities, will count very little, if at all, against their credit limits in international markets. Because it is next to impossible to set objective credit limits for government borrowers, international lending institutions and their supervisory authorities frequently use arbitrary ratios in lieu of judgment. As the great majority of forfeiting transactions involve East European countries and some Middle Eastern and Latin American governments, forfeiting may represent a device for evading credit rationing in the Western banking system. A different twist on an old trade financing technique is the domestication of securities issued by foreign borrowers in national markets. For example, several Brazilian borrowers have gained access to the U.S. commercial paper market by having a domestic bank open a letter of credit on their behalf. 2. From a legal perspective, this makes the bank the primary obliger and the paper becomes an acceptable investment for institutional investors which normally face externally or self-imposed restrictions on holdings of foreign securities. The market for these instruments represents an example of the phenomenon of external markets that coexist and compete with their domestic counterparts. The concept is by now well accepted. An international instrument, identical to the domestic instrument in all respects except location of issue, will be free from certain costs or constraints. In practice, not all such instruments succeed, because not all serve a genuinely unsatisfied need in the most efficient fashion. Indeed, the supply of Eurobonds was for a long time inhibited by the high cost of issue and of organizing a secondary market. The basis of the Eurobond's success is an inconsistency in regulation. Governments tend to limit the access of foreign issuers of bonds to their national markets, but have less stringent or non-effective controls on domestic investors who purchase foreign bonds. Internationally active investment banking firms can therefore issue bonds and similar debt instruments in such a way that national restrictions are bypassed. The issues are given the legal form of private placement and/or placement in non-resident investment accounts. 11. The history of the Eurobond sheds an interesting light on the process of financial innovation. Although the pattern of regulation has been in existence for a long time, the market for Eurobonds did not develop until 1964 when the U.S. Balance of Payments Program, particularly the Interest Equalization Tax, IET, closed the U.S. market to foreign borrowers. Until that time, this market had been reasonably open to all borrowers who were able to comply with SEC accounting and disclosure requirements, largely public entities from developed countries. No doubt a major factor preventing the earlier emergence of the market and contributing to its subsequent erratic growth was the difficulty of developing an organized secondary market for bonds sold in a variety of countries and lacking an integrated mechanism for trading. Substantial sales began only in the mid-1970s, 10 to 15 years after the first Eurobonds were issued. By that time, the volume of bonds outstanding had reached a critical point at which economies of scale in the secondary market came into play. Also, the gradual entry of institutional investors who trade in response to relatively small incentives contributed to the development of an active secondary market. 12. Indeed, when the IET was reduced to zero in January 1974, the Eurobond market continued to flourish, side by side with the revival of the market for foreign bonds in the United States. 13. By this time, the instruments developed in the Eurobond market had spawned features distinct from those of the foreign bonds issued in the U.S. market. They are now quite different from bonds issued in any of the national markets. 14. This paper would be incomplete without a brief consideration of the most eminently successful of post-war international financial innovations. The euro currency, or external money market, competes directly with the domestic wholesale money markets of many countries. 15. The necessary condition for the existence of an external money market is that certain regulatory costs affecting both deposits and loans can be avoided by placing time deposits and loans on the books of financial institutions operating in jurisdictions that do not impose costly regulations, such as reserve requirements, portfolio restrictions. The relaxation of comprehensive exchange controls on both residents and non-residents has facilitated the international transfer of funds that arises in the course of transactions related to external intermediation. This innovation has contributed significantly to the ease with which savers' and borrowers' needs can be reconciled, regardless of geographical location. Funds of great magnitude can be intermediated in a context of unrestricted competition, virtually free of administrative credit controls affecting either price or quantity. In essence, the euro currency market has performed an important unbundling service by permitting the separation of country of jurisdiction from the currency of denomination of financial instruments. The euro currency market has itself stimulated the development of several new instruments. As occurred in the U.S. money market, a successful market for negotiable certificates of deposit, CDs, has been created in London. These instruments, known as London dollar CDs or Euro CDs, have been called the first new negotiable instrument created under English law since 1896. 58, page 608. Their function is obvious. They represent euro-dollar deposits with negotiability and potential liquidity. Unlike eurodollars per se, Euro CDs were created not by regulation, but by the desire of the issuing banks to have assured availability of funds while providing the depositor with the liquidity of an actively traded negotiable instrument. The key to the success of the Euro CD was therefore the development of a viable secondary market in London. Two financial institutions undertook the initial investment in hopes of gaining a sufficiently high return before competition began to deprive them of the rewards for innovating. With hindsight, it can be said that they were disappointed. 16. Other banks quickly began writing similar paper in order to obtain funds at lower rates than were available through deposit taking. Many lenders prefer CDs which provide them with liquidity, 17, and are therefore satisfied with a lower yield. The innovators in the secondary market did not fare much better. Apart from White, Weld, and Company, whose strength was in the underwriting, the secondary market in Euro CDs was dominated by the British discount houses that began dealing in these instruments as a sideline to their main business in short-dated governments, acceptances, local authority bonds, and so on. When the volume of CDs outstanding had reached approximately $5 billion, the large US-based money market dealers, using their extensive information and retail networks to good advantage, began outcompeting the London discount houses and to a lesser extent the brokers, in both the new issue business and much of the secondary market. 53, page 422. Today, the U.S. dealers play an important role in the Euro CD market, just as they do in the domestic CD market. At present, the liquidity of the Euro CD secondary market is less than that of the U.S. market, largely because of the difference in volume. At the end of 1980, the value of Euro CDs outstanding was approximately 1/4 of the volume of the domestic CDs. Domestic banks, as a rule, have a wider range of stable sources of funds, ranging from demand deposits to equity capital. To the extent that these funds are insensitive to interest rate changes, domestic banks can afford to make loans at fixed rates. Eurobanks, in contrast, are specialized wholesale banks that rely on a sole funding source: large external time deposits, mostly from highly interest-sensitive depositors. The Eurobank's cost of funds therefore varies directly with the level of short-term interest rates. How could they make term loans without facing considerable interest rate risk? The answer was the rollover credit, or revolver. Under this arrangement, funds are committed to the borrower for medium-term periods, such as 3 years, but the interest rate changes every 3 or 6 months in direct relation to prevailing short-term rates in the euro-dollar interbank market. Thus, the availability of funds could now be assured for longer periods than the interest commitment period, and medium-term loans could be safely funded by obtaining 3 or 6 month time deposits. As interest rates began to fluctuate more widely, the advantage of distinguishing the loan agreement period from the interest rate period became increasingly important to the banks. Customers found these arrangements acceptable, because they were able to avoid the risk of loan non-renewal. Non-financial enterprises are, as a rule, more willing than banks to bear an interest rate risk, especially if their net operating cash flow exhibits some positive correlation with interest rates. Today, the overwhelming majority of euro lending is done on a floating rate basis, as is appropriate for periods in which inflation and interest rates fluctuate widely. From the revolving loan, it was only a small step to the floating rate note, FRN, introduced in 1969. The FRN allowed some corporate borrowers to obtain funds directly from non-bank sources at interest rates that varied with short-term bank rates. These instruments allowed investors greater flexibility to focus on real interest rates in an environment characterized by unprecedented uncertainty about future movements of rates. The growth of FRNs has been impressive. In the first year of issue, the volume was approximately US $15 million. In 1976, the volume was well over $1 billion. 18. During the Herstatt crisis of 1974, banks learned to appreciate the fact that whereas the overall volume of funds available for deposits may be quite stable, or even expanding, individual institutions are not immune to a funding risk. Hence, the introduction of the bank FRN and the floating rate CD, which differ only in terms of subordination, provided the banks with the same unbundling of risks that the revolver had provided to their customers. 19. Floating rate CDs enable banks to be assured of the longer-term availability of funds, while allowing the interest rates on their liabilities to vary periodically with market rates. In addition, appropriate placement policies allow the issuing bank to broaden and diversify its sources of funds. As compared with banks, relatively few corporate borrowers use this vehicle, preferring instead revolving loans from banks and the commercial paper market. 49. Interestingly, occasional experiments with more complex clauses such as provisions for early redemption at the holder's option at declining discounts from par, or issues with declining spreads over the interbank deposit rate have not been successful. Investors seem to have a strong preference for instruments which are conceptually simple. 20. As corporations became aware of the different forms of loans and currencies available in the eurocurrency market, a logical step was to structure loan agreements that would allow them to draw down funds on their borrowings in one or more stipulated currencies. The choice tends to be limited to those currencies which are convertible, and for which external deposit markets, 21, or active forward markets exist. The pricing is based on the London interbank rate, plus or minus a currency adjustment factor equal to the forward premium or discount prevailing in the foreign exchange market. Multi-currency option facilities represent just one example of a whole class of instruments that reflect the intimate linkage between interest rates and exchange rates in a multinational market. The instruments differ in how they bundle and unbundle credit and currency transactions, the precise configuration being determined by transactions costs, regulation, and other market imperfections. The basic instrument in foreign exchange is the forward exchange contract, where two parties agree to exchange currencies at a predetermined rate at a specific time in the future. 22. While the forward foreign exchange contract is, of course, not new, there are two variants that warrant notice. The first is the well-publicized futures contract, in effect a standardized forward foreign exchange contract that is negotiable, saleable prior to maturity, and guaranteed to be relatively free of default risk. These features, together with the small denominations in which they are available, make the risks and returns of exchange rate changes accessible to the small investor. Such investors have therefore been willing to pay the higher transactions cost of the organized futures market. Despite such differences, empirical evidence reveals no statistically significant differences between forward and futures prices. 12. The second variant of interest is the use of a forward exchange contract in conjunction with a credit arrangement which effectively changes the currency of denomination of that deposit or loan. A number of these combinations will be reviewed below. However, the general principle is that the currency of denomination of an asset can be converted by contractually selling the future cash flows from that asset for another currency. Similarly, the currency denomination of a liability may be altered by contractually purchasing the foreign currency necessary to liquidate that obligation. The remarkable feature of this use of forward contracts in the eurocurrency market, for example, is that it enables banks to have fair deposits or loans in any currency for which there is a forward exchange market, even if no external money market exists in that currency. The result is that the eurodollar is the only full-fledged external money in existence. Other eurocurrencies are often simply eurodollars linked to forward exchange contracts. Currency swaps. While the term swap has come to refer to almost any arrangement that incorporates a forward foreign exchange contract, currency swaps simply denote an agreement to exchange certain amounts of currencies on a spot basis and to reverse the transaction later at a specified time and rate. Currency swaps are used widely by foreign exchange traders who wish to limit their risk over time. When the regulatory environment compels it, corporations sometimes find long-term currency swaps useful. The simultaneous spot purchase and forward sale of a foreign currency serves to lock in any difference between the spot and forward exchange rates. The difference, often referred to as the swap rate, represents the change in value of funds at two separate points in time, and is therefore the equivalent of an interest rate. Because a currency swap locks in the nominal cost or return of a temporary conversion of funds into a second currency, it can be used to compare the rates of return in two currencies. Credit swaps. This instrument explicitly ties together a credit transaction and a forward contract, or their equivalents. A typical transaction would involve a firm in country providing hard currency funds for its affiliate in a weak currency country. The parent company, for example, would lend dollar funds to an intermediary, a commercial bank, or even the central bank of the weak currency country, which, in turn, lends local currency funds to the foreign affiliate. At a predetermined date in the future, the transaction will be reversed. The cost of the transaction is the interest rate on the dollar funds less the interest rate on the local currency funds, adjusted for the swap rate, the difference between the exchange rates used to convert the parent's funds into, and later out of, the affiliate's currency. Because of these contractual relationships, the intermediary, local or foreign central bank, bears the burden of the exchange risk on the dollar principal. The interest on the local currency loan, however, is subject to exchange risk in dollar terms. Market imperfections provide the rationale for firms and intermediaries undertaking such complex deals instead of simpler alternatives, such as borrowing in the local money market, or lending dollar funds covered with a forward contract. Neither forward cover nor access to local credit markets may be available at reasonable rates. For the intermediaries, such credit swaps are a means of bolstering their foreign exchange reserves, using the financial needs of captive foreign affiliates to obtain these reserves at a lower cost than might be available through outright borrowing. Moreover, because they are close to the political powers that determine extent and timing of devaluations, they may be able to assess the foreign exchange risk better than private companies. Indeed, the intermediary bank is frequently the central bank itself. A special form of credit swap is an arrangement whereby a claim is denominated in one currency, say, dollars, but the amount of principal and interest to be paid each period is determined by variations in the dollar exchange rate of another currency, such as yen. Thus, if, 1 year after the issue of such a bond, the yen has risen by 5%, the dollar amount of principal and interest to be paid also rises by 5%. The purpose of this instrument, which is effectively a yen-denominated claim, is merely to avoid taxes and restrictions on securities denominated in particular currencies, such as yen. 60. RB loans. This variation of the credit swap occurs when one unit of an integrated firm transfers funds to another unit to take advantage of capital market imperfections. The first affiliate borrows locally, at an advantageous interest rate, and passes the funds to the second affiliate for use in the latter's currency. The loan is covered with a forward contract. In effect, the first unit acts as an intermediary, undertaking arbitrage between two financial markets. It is able to do so only if it has both access to cheap local funds and a means to move them out, say, via dividends or other intracompany payments. The funds are cheap in the sense that the difference between the local interest rate and the interest rate in the foreign currency exceeds the swap rate. Parallel loans. This is an arrangement under which two corporations, or other institutions, in different countries make loans to each other in their own countries and currencies. The classic example is that of an American firm making a dollar loan to the U.S. subsidiary of a British company, while the British firm simultaneously makes a sterling loan to the British subsidiary of the American firm. Such dollar-sterling parallel loans are concluded at an interest rate differential reflecting the difference between long-term interbank rates. Each loan serves as collateral for the other and bears an interest rate related to local credit conditions plus the putative cost of a long-term forward exchange contract. Unlike some of the earlier examples, this technique is purely a byproduct of regulation. It enables firms to avoid capital, and perhaps also credit, controls. 23. In concept, it is a costly and clumsy arrangement. Two parties with matching needs have to be brought together, and the agreement is a combination of 3 financial contracts, 2 loans and 1 implicit forward transaction. Only regulations which constrain credit allocation or prevent free capital flows justify its existence. 24. Our contention is that international financial innovations are likely to succeed only if they offer 1. A means of circumventing regulation, 2. An unbundling of previously linked financial services, or 3. A combination of services with relatively low transactions costs. Moreover, even if they fulfill one or more of these conditions, their success is likely to be hindered unless a secondary market or the institutional framework for such a market is already in place. A prime example of this concept is the currency basket Eurobond, much touted by international bankers and officials in past years. The intention was sensible. By offering a bond whose value was linked to a weighted average of several currencies, issuers provided investors with ready-made currency diversification. 25. Some have even been denominated in special drawing rights, SDRs, a basket of currencies, backed by the IMF. Yet compared with total Eurobond issues, currency combination bonds have failed dismally. 26. Why? Banking practitioners claim that some of these currency baskets have been expensive to administer, and that they included minor currencies in which the investor had no interest. It has also been said that investors simply did not understand them. Although there may be some truth to this, the true reason is probably much simpler. The portfolio of the typical international investor is sufficiently large to allow him to obtain currency diversification tailored to his specific needs at little extra cost, for example, through the purchase of different bonds denominated in single currencies. This contention is supported by the fact that not only did complex, multi-currency formulae fail, but simpler units, based on only a few major currencies, also fared poorly. 11. In the early 1970s, about a dozen U.S. multinational companies were persuaded to issue dollar-denominated commercial paper in London as an alternative to borrowing eurodollars, largely to comply with U.S. foreign investment restrictions. What the promoters of the innovation overlooked was that the spread between deposit rates and borrowing rates is necessarily narrower in the euro market than in the domestic banking markets, and therefore the cost of intermediation was very low. Borrowers could save very little by going directly to investors for funds. This fact, together with the cost of issue and distribution, made the advantages of the instrument minimal, and the volume of euro commercial paper issued was very small. Euro equities were an innovation that existed only in the minds of fast-working financial writers, who saw in the success of the Eurobond market the possibility of a similar opportunity for equities. As quickly became apparent, however, only fixed-interest Eurosecurities, for example, Eurobonds, can be sufficiently differentiated from their domestic counterparts to make possible issuing techniques that circumvent those restrictions and tax effects common to issues in national markets. Euro equities, wherever issued, would give a claim on the residual income of a subsidiary in an integrated corporation and so would not differ from parent firm equities. Thus, one of the major preconditions for euro equities, their regulatory advantage over and distinction from national equities, never existed. The few issues were actually either fixed-interest securities with an equity feature, similar to convertible bonds, or internationally distributed shares that were in no way different from those issued in a national market, and the end result was that many drifted back through arbitrage as soon as prices showed the slightest difference. During periods of monetary and economic instability, there is an obvious need for financial contracts that allocate equitably among borrowers and lenders windfall gains and losses arising from sizable, unexpected interest rate movements. Because nominal interest rates are determined largely by expected rates of inflation over the term of the contract, it is tempting to try to insulate financial contracts from unexpected changes in the price level by tying the yield to some index that represents this inflation factor. Yet a survey of the world's financial markets shows that index-linked financial assets are few and far between. Even where they have been tried, they were often no more than relatively short-lived experiments. 45. Why have they consistently failed, given that the basic concept appears to be sound? 27. The fact that we do not find indexation in the unregulated international markets suggests that there must be problems other than governmental opposition. One possible obstacle is that of finding an acceptable index. The usual price indices, consumer, wholesale, and GNP deflator, are not universally acceptable. The various goods that make up an index, or the weights assigned to them, may or may not be relevant for particular borrowers, or lenders, or both. Another problem is that the index must be objective and verifiable. Price indices in many countries are often not credible, because they are believed to consist of political numbers manipulated by the government. Whereas it may be possible to overcome these technical difficulties, though at some cost, there is a more cogent reason why index-linked financial contracts are very rare. There exists a ready alternative, which is to shorten the maturity of the pricing contract. Floating rates capture most of the variation in inflation, and they may have succeeded where index bonds have failed because market interest rates are objective and verifiable. Even more rare than index-linked bonds are those where the principal, and possibly the interest rate, is tied to the price of a commodity. These instruments, more properly termed commodity equities because they are bonds only in the sense of seniority of claims, might provide an issuer with the assurance that his liability would rise or fall in line with his revenues. Thus, this instrument has been suggested as a solution to the debt problems of developing countries that rely for export receipts on one or two commodities. 28. From the international investor's perspective, commodity equities, if objectively indexed, provide a means of participating in the risks and returns of primary producers. 29. Yet the fact that very few of these instruments have been floated suggests there may be problems on the supply side. First, the issuer is protected only on the revenue side. Should his costs increase by a similar amount, the burden of servicing the increased liability will be considerable. Second, rising prices for the commodity may coincide with a decrease in volume, further affecting net revenues from which the liability must be repaid. From the investor's perspective, changes in the value of his asset, the particular commodity, may not be linked to the cost of his consumption basket. It is not surprising that few of these instruments have actually been issued. During the late 1960s, a market appeared in London that anticipated the now thriving interest rate futures market, but itself never took off. A forward, or more correctly, a forward euro-dollar CD, is a contract to issue a euro-dollar CD at a fixed interest rate at a given date in the future. Such contracts, in conjunction with the issue of ordinary, spot, CDs, effectively constituted CDs of longer term than were at that time legally permitted in the UK. However, since the same effect can now be achieved as easily by simultaneously buying JNG and selling CDs of different maturities, participants in the eurodollar market have not employed this technique to any great extent. Whether the introduction of standardized euro-dollar futures contracts traded in organized markets will be able to capture the advantage of unbundling of two financial services, a pure interest rate plus a forward contract, remains to be seen. Finally, several authors have pointed out the apparent need for puts and calls in spot foreign exchange. Shapiro and Rutenberg predicted in 1976 that they will be available soon. 51, page 53. These contracts involve two parties, a firm and a bank, for example, one of which has the right to purchase a currency at an agreed-upon exchange rate any time between two given dates. It has been shown that call option prices are tied to interest rates on single currency and currency option bonds. 24. Conceivably, a firm could employ foreign currency options whenever it faces future cash flows that are fixed in amount but of uncertain timing or execution. Standardized contracts could make them accessible even to small investors on the organized futures markets. Indeed, commodity options have attracted some investor interest. Such contracts do exist. 30, page 57. 3. but have never attained the status of an established market with publicly known prices. The reason may lie in part in the specialized nature of such instruments and the consequent difficulty of establishing a secondary market. A more persuasive reason, however, is that a bank offering an open options contract exposes itself to considerable risk. Such risks are difficult to offset. 30. And a bank entering into a large number of option contracts would likely face regulatory constraints. In the absence of evidence to the contrary, therefore, we attribute the slow growth of foreign exchange options to government intervention in bank portfolio decisions. Despite the fact that the decade of the 1970s appears to have been demonstrably more conducive than previous decades to the generation and support of international financial innovations, a number of well-publicized innovations have not met their proponents' expectations. The cost and success rates of past innovations are important determinants of the future rate of innovation. In the author's view, the probability of success can be enhanced by drawing on the lesson of past failures, which is that in order to succeed, the innovation must involve a genuinely new combination of standard financial elements and must bridge a gap arising from some change in the regulatory or economic environment. Judging the degree of success of a new technique is tricky. Demand for some instruments is low merely because they successfully fill a narrow market need, and most innovations with an identifiable likelihood of failure never see the light of day. These reservations notwithstanding, Table 1 summarizes the major innovations and their characteristics. Next to each technique have been identified the major facilitating factors, such as regulatory circumvention, and the primary supply constraints or influences. Several public policy implications emerge from the theory and this survey of financial techniques. Innovation is a public good, and as a rule there is a presumed rationale for the public production of public goods, where, as in the case of financial innovation, it appears that government agencies would be inadequate. There exists a case for patent protection or subsidy of innovators. Patents, however, are impractical for financial contracts, and the government cannot easily determine the appropriate subsidy for a financial contract. One form of subsidy might be in the support of secondary markets. Government might commit itself to absorbing part of the losses of market makers. Whereas this is done to some extent, through the tax system, by governments seeking to develop domestic capital markets, it is difficult to conceive of a mechanism for secondary market support on an international scale. Table 1. International financial innovations in the post-war era. This leaves the risks and rewards of financial innovation largely in private hands, and especially in the hands of those financial institutions whose reputation allows them to appropriate the returns from financial product development. Whether the rate of innovation that occurs in this fashion is socially optimal or not is impossible to say, although it seems probable that society as a whole would have gained from the earlier development of secondary markets for some instruments such as Eurobonds. In conclusion, therefore, the public policy implications are primarily negative ones. First, it is contrary to the public interest, at least in this context, to seek to inhibit the risk-taking behavior of resourceful, reputable financial institutions. It is precisely they that have a comparative advantage in gaining a return from investments in new financial ventures. Second, the fewer the regulations that are placed on individuals or firms' access to the full range of financial contracts, the greater the gain from, and reward to, innovation. The fewer the resources devoted to circumventing regulation, and the more resources allotted to the task of devising contracts that fully match investors' and borrowers' needs.